moment to introduce what Loans for SME does. We are a platform that connects lenders to borrowers, and we provide access to cash flow based working capital financing for small and medium enterprises. We work with more than 50 institutional lenders, and we have a product suite ranging for over 15 products, and that covers all financing needs for growing businesses. That could be your short-term financing requirements, to capital financing requirements, to even project financing requirements. Our lenders are typically new age lenders, and these lenders are like a non-banking financial services company. It could be a venture debt firm, it could be family offices, and with that access to different capital, we're able to service the loans and requirements for smaller companies, which may require more interesting structures and more suitable for growing companies. I'd like to introduce my senior colleague, Simi. She's the founder for Loans for SME. She has more than 20 years of lending and credit experience and has worked and headed venture debt firms, banks, and credit agencies. And I'd like her to take you through what the debt landscape in India looks like and what could possibly be suitable for companies who are in the renewable sector, who are focused on energy efficiency products and services and distribution strategies. So over to you, Simi.
Thanks a lot, Meenakshi. Hello, everyone. Thanks for taking the time to join us at this webinar today. Kevina, can I have the next slide, please? So, anybody who works in clean energy today, be it cook stoves, be it solar, has no doubt that this is a sector with a lot of ambition. Kevina just mentioned earlier today that cook stove market has ambitions to grow to 100 million households. We have all heard of solar, and the government's targets to build 175 gigawatts of renewable energy capacity in the next 5 years. So this is a sector that is both young, because technology as well as most companies in the sector are relatively new compared to traditional sectors, but also a sector with a lot of ambition to grow very quickly. Now what that does is, next slide please, is create a gap in terms of financing these ambitious targets, because growth needs capital, and we estimate that renewable energy, clean tech infrastructure, cook stoves, distributed renewable energy will need a financing of as much as $300 billion over the next 5 years to meet these ambitious goals. Next slide, please, Kevina. Actually, if we just go to the next one after this. So essentially, if you think about a sector that's rapidly scaling up, and you are entrepreneurs who work in this sector, it presents its own unique set of challenges. So you need $300 billion of capital to meet your ambitious growth targets, but at the same time, as promoters, the equity that you have is limited to your own assets. Yes, there is venture capital and private equity money available in this sector, but raising that equity is a long, time-consuming process, which essentially takes a lot of companies, promoters, entrepreneurs to think about. We should raise debt to meet our growth targets. We need more working capital, we need more capital expenditure to build plants, we need to fund our receivables, so we should raise debt. Unfortunately, especially in India, the traditional lending system has proven to be both inefficient and unable to cope with this demand that exists in the sector. Largely because banks have traditionally looked at lending against collateral, which means real estate, and where entrepreneurs, especially first-generation entrepreneurs, lack that, they are unable to tap bank funding leading to, not just, them not, growing, but, often landing up in situations where they can see clear business opportunity, but are not able to capitalize on that because there is no financing available. So what we want to do today is to spend some time, looking through what different options of finance exist, to you as an entrepreneur, and why and where debt fits into that whole landscape, and why should we be thinking about it. Next slide, please, Karina. So I'm going to spend a few minutes just talking about all the different sources of financing that you have access to as an entrepreneur. And if you can just go to the you have available. A lot of entrepreneurs, when they first start a company, are focused on getting equity in. There's obviously a lot of noise as well as attention given to companies who are able to raise VC and PE funding. So typically, most of the founders, stay very focused on the two sources you see on the left side of the slide, which is VC or PE investment companies or HNIs and angels who could bring in equity to fund the company. I would, however, like you to pay attention to the right side of the slide, because in my mind, while we're talking about debt here, there are multiple choices available to you as an entrepreneur just beyond equity. So there's obviously debt from bank and lending institutions, but there's also, especially in renewable energy and cookstove sector, grants and government schemes available. And you can also, think of, your suppliers, the credit they give you, or, even, ESOPs that you can give your employees in lieu of cash payments as essentially a source of financing the company. Next slide, please. So what we're going to focus on is really ways for you to think more closely about the right side of the slide, which is, in my view, the most smarter funding, because unlike equity, you're not diluting your own stake in the company, but are paying a fixed cost to use that capital. Next slide, please. Now, a lot of times, the question we get asked is, we are a very young company, as a lot of companies in the clean energy sector are. Can I get a debt? And the answer to that is yes, but you have to think about, are you ready for debt? And are you at the right stage for debt? So this is how I think about, what's the right time to raise debt. So equity is essentially risk capital. When an equity guy comes in, you may have no revenue, you may not even have a business model, but they are essentially betting on the future potential that your idea or your business has. This continues to be the case even as you grow, but you just get different kinds of equity, moving from angels to VCs to private equity. But there comes a time in your business when you reach a stage of stable revenues. So you have a little bit of visibility on how much cash you're able to get in month on month. And that is a time when you start thinking about debt. So if I have to put an approximation to it, you're essentially looking at first starting to think about debt at between 6 to 12 months after you reach a stable level of cash flows and revenues in your company. So why should you think of debt at this point of time? Why not just keep on raising more equity? Next slide, please, Kevin. So think of it this way, right? So both debt and equity are components that you need to have and will have in your business as part of a capital structure your business grows. Equity is important because you are bringing in people who are sharing into your risk. But if you keep on bringing in more and more equity, over time, you dilute more and more stake as an entrepreneur, and your personal interest in the business keeps going down. it's also the most expensive form of capital you can raise. Just because equity investors expect, anywhere from 25% IRRs and upwards, and will take share in all your future profits. So that said, you bring in equity when you first start out, when you're very risky. But once you get to a stage where you are de-risking your company, you are getting to a stage where you can predict, what cash flows you have. Debt financing keeps the ownership with you. It helps you structure repayments back to the capital owners, not based on, say, completely exiting the company or an IPO, but this essentially matches the capital you're paying back to the people who've given you capital, the lenders, when you receive the cash flows back. So, you essentially get an order, you need 100 rupees to execute that order, and you take the debt, and once you make money on that order, you repay it. That essentially makes it both non-dilutive and also more in sync with your cash flows as a business. So I'm going to take some time now to just walk you through what debt products are out there that you should be thinking about as a business, and which ones would make sense to you working in the sector that you're working in, and also spend some time just clarifying what basic concepts are, how secured and unsecured debt works, and what that even means, and which are the kind of lenders that you can go to. So Kiran, if you could just go to the next slide, actually the one after that. So I think the first thing that you need to know, even before you start raising debt, is how are we gonna back up this debt? Because traditionally, banks have been looking at what's called a collateral-based loan, which means that they are focused on taking your property, say, either a factory you have, or even more commonly, your own personal house, and using that as a security to give you a loan. Banks do that because they think that it's easier for them to then just, rather than try to understand your business, rely on the value of the security they have been given. And this is what would usually be called a collateralized or a secured loan. What we are focusing on, and what probably makes a lot more sense to businesses like yours, is what's called an unsecured loan. Now, let me be clear that when I say unsecured, it does not mean that you just get to just walk away with money. It basically means that the lenders do not ask for collateral or a physical asset or a property. What they're essentially looking for then is to see how your company's future potential, your future cash flows, and the strength of you as a founding team, as an operations, can be used as a proxy for them to assess, whether or not they should give you a loan. Now, who will do a secured versus unsecured loan will definitely depend on which kind of lenders you approach. But the more unsecured a loan, the more the diligence gets closer to how an equity guy would look at you, and focusing on the cash flows of the company. Next slide, please. So all the different lenders that are out there who are lending to these companies, and these terms can get confusing, so I'll just start with the simplest one, a bank, which all of us know, which typically would do a collateral-backed loan. So you give them a property and they'll give you a loan against that. Other kind of lenders that have more recently come into the market and are now looking at both innovative structures and new age industries include non-banking finance companies, and there are many kinds and a huge number of those. Venture debt funds, and in a few minutes I'll just walk you through what a venture debt means and why it makes sense for certain companies. There are also people who are doing more high-risk debt, which is more equity-like in nature. And we typically see that kind of capital coming from family offices as well as HNIs and angel investors. There is also a new category of lenders that we have seen emerging in the last couple of years, which is the leasing company. So again, these companies are looking at the assets you are creating and what kind of cash you will generate from these assets, and using that to structure a loan. Now, structuring the loan itself is super complex, right? And there are essentially tens of ways you can do, uh, a loan. You can do, what's typically called a cash credit, which is just a limit you get from a bank, and it's typically secured by a collateral. But we have, over the last year, essentially worked with our lending partners to create 4 or 5 structures that we think make the most sense for a business like yours that is working to essentially create a footprint of clean energy assets, which means that you're essentially either selling cook stoves or putting up projects and need funding for setting up these projects, and then need funding because your customers take time to pay you. So the most common products, and I'll talk about 3 or 4 today, that would make sense for you, are essentially the ones that would help you better manage your working capital cycle, because that is going to be your biggest need as you grow your business rapidly and lock more and more capital in buying inventory, in keeping raw material as well as finished products in stock, and then selling to customers who take a while to pay. Kavina, next slide, please. The first product I want to talk about is something called invoice discounting. One of the most common problems that businesses have is that your customers do not pay you immediately, which means that even though your sales are increasing, your actual cash may not be increasing because your customers take 3 to 6 months to pay you back, sometimes even longer in case of, say, government contracts. So what you do in invoice discounting is essentially use the invoice that you've raised from a customer as a security and get financing against that. So say you raise an invoice of 100 rupees that is due to you 3 months down the line, you can get, say, 90 rupees out of that 100 immediately as a loan, which is called invoice discounting. We find this to be very relevant for companies who have long-term contracts with customers, who have visibility on who their customers are, and most importantly, the customers themselves have good credit rating. Because what the lender is relying on here is the fact that you have raised an invoice on a customer who will pay this 3 months or 4 months down the line. Again, this is something that is more useful for young companies who haven't had time to establish a track record, establish a credit lines with the banks, as well as for older companies as they grow rapidly and are not able to have bank lines keep pace with their growth. In fact, my favorite product, and the one that I think is most relevant to anyone struggling with working capital issues. Karina, next slide, please. But sometimes, companies have a problem even before they bill a customer, right? Because they receive a large order. And we see that a lot in tender-based businesses, as well as, one example I remember is of a cook stove company, for example, who's working with large corporate CSR funding departments and are getting orders to deliver cook stoves. But they then need capital today to manufacture those cook stoves, deliver that, invoice that order, and then get the money back. Now, this whole cycle takes anywhere from, say, 3 to 9 months. But you need money today to essentially start manufacturing the product for that order. And this is where work order-based financing comes in. So what you do in work order-based financing is essentially get a confirmed PO or a purchase order from a supplier that the lenders considered creditworthy, the lenders considered that they will essentially pay on time, pretty much very similar to the invoice discounting, and you get funding upfront to buy the raw materials or pay your suppliers to manufacture an order. Now, 2 things are critical for any company looking for work order-based financing, right? 1, the lenders need to be assured that you have capability to deliver that order. And 2, once you deliver that order, your customer will pay you. So this is essentially where the entire diligence will focus on. Next slide, please. I'm going to quickly talk about two other products which are more general before we go into the specific case studies that probably give you a better flavor of what this could mean in real life. But essentially, there are instances where both invoice discounting and order-based funding may not be a possibility, mostly because the funding you need is more general purpose. Say you have to give somebody a guarantee and need to kind of have some funds to put with your bank against that. Or you just need short-term working capital for your regular business purposes. And that's when you can essentially ask for an unsecured business loan. Typically, because you're not escrowing specific cash flows for this particular loan, the amount you get might be lower than what you can get in invoice discounting. But this is a funding that will still be linked to your month-on-month cash that comes to the business. Next slide, please. Also, once the company starts to get a little bigger and raises venture capital, venture debt becomes an option. The way venture debt companies typically work is that they give you a long-term loan without any collateral because they are relying on your equity investor to have done diligence and understood that this is a viable business model. So usually a venture debt fund would come in and lend to companies who already have a VC or a PE investment in place and will essentially co-lend either along with the VC round or after the VC round. So this essentially, these four products, so invoice discounting, order-based funding, and if none of them work, then unsecured business loan, or for larger companies, venture debt, is what we think solves most of the working capital gaps that a cook stove or a clean energy or a project company can have. I'm not sure if there are any solar entrepreneurs here, but I will quickly touch upon a very specific product that we also have for rooftop solar. Camera, next slide, please. So we also work with several lenders who are specifically focused on rooftop solar space and are able to offer funding both for EPC companies to set up the projects and long-term funding against PPAs to the asset holders. Typically, this would be a 10 to 12-year funding that would be in line with the cash flows that you receive by selling power to either a commercial or a highly rated industrial establishment. Just thought I would mention this here to complete our portfolio of the clean energy products that we have. Camera, next slide, please. So as I mentioned earlier, as Loans for SME, we focus on lenders who offer collateral-free loans. Now, while there is no collateral, any loan that you take, and this refers to all the different products that we talk about, would be backed by some form of security. Now, these securities can be what's called a primary security, which means that the assets on the company's balance sheet are being used as security, and this could be, any fixed deposits you have in the company, or charge on your receivables, or charge on any assets in the company. And while we stay away from collateral security, which is the personal property of promoters or the entrepreneurs, I will mention one exception to the rule that's pretty much the market standard in India. Lenders almost always ask for personal guarantees of the promoters. The reason they do that is that because the only security they have when they offer you an order-based financing or invoice discounting is that you as an entrepreneur will run this business and run this well enough for the lender to collect money from the cash flows of this business. Hence, the personal guarantee is more of a moral obligation or moral suasion that lenders think of when they do a loan to a company, even if it's uncollateralized. So, a very natural question here is that, can anybody get, an invoice discounting or an unsecured business loan or venture debt? or essentially how do lenders assess whether or not you're eligible for a loan? Next slide, please, Karina. And it is usually quite a complex process in terms of understanding. Uh, Usually based on a model, and most banks, lenders, NBFCs have some form of, what's called a multi-factor model where they look at hundreds of parameters, largely focused on 4 or 5 key areas, right? So one is the entrepreneur or the team that's running the business and their experience and how relevant that is to make that a successful business. The other is your operations and, which states you're present in, how well is your team structured to execute the business in these states, if you have, all the processes in place or not. Then there is obviously the biggest chunk of, essentially focus, which goes on actually assessing your cash flows. And that goes back to, looking at your financials, so your audited as well as unaudited financial statements, but also things like your bank statements, your tax returns, your GST filings, all to make sure that essentially what lenders are trying to do here is, being very boring and just basically confirming everything you've told them about your business and just understanding how much cash is actually coming into the business. So all of these parameters go into, usually some form of a risk assessment model, which gives out a credit score that then allows the lenders to make a decision on whether or not to do a loan. Next slide, please. I will just add that, it's not just the business, right? Entrepreneur or the promoter of the company, the team running it, is a big, big factor because that's what they're betting on. And which is why, even if your company has not taken a loan and has no credit history, your personal credit history becomes very important. I always tell entrepreneurs this, that, if there's a credit card loan or a student loan you have taken, and you think that, there is a small default of like 5,000 rupees somewhere that's not relevant, trust me, it's relevant. So CIBIL, which is essentially the market standard for tracking, all the loans you have taken and how you're performing on them. Even if they're small amounts, I think any delays or any overdues signal to lenders the intent of paying a loan back on time. And that's really what the core of what they want to do is, right? They essentially want to see whether if they give you 100 rupees today, will you pay it back on time? So while the models really look at the capacity to repay based on your financials, a lot of decision usually relies on what lenders perceive of your intent to repay, and your own personal credit history is a big, big factor there. Next slide, please. The way the lending process usually works, and it's typically, starting from, say, a 2-week process with digital lenders to many months of process with banks, but the basic premise is the same, right? So you make an application, they look at a whole lot of data that they've taken from you, and based on that data decide whether or not you are a good fit for, what they would typically lend to. If the answer is yes, the lenders will spend, say, a day with you or 2 days with you, depending on complexity of the business, meeting your team, understanding all the different details of your operations, of your financials, and then take it to the credit committee for an approval. This whole process usually involves a lot of back and forth between the company and the lender in terms of collecting a lot of documents, as well as discussing the intricacies of both the operation and the financial data. Next slide, please. Now, I do understand that all of that I've told you is complex. There's lots of jargon. Lenders almost always speak a language that entrepreneurs do not. And you as an entrepreneur don't want to be spending all your time, essentially going to lenders separately, rather than running your business. And that is the core premise under which we set up Loans for SME. We know that as entrepreneurs, you want to focus on your business. You're not experts in debt. You don't speak the language that lenders speak. So what we do as a platform is essentially help you traverse this completely complex landscape of, who should I go to, who's the right lender for me, what documents you need, by converting the entire process to essentially, you give us some documents online, so there's no stacks of paper to print. We have already built a network of lenders and understood in depth what the decisioning parameters are. So then based on our algorithms and our credit assessment, we can say with a fair certainty what the right structures for you and what the right lenders for you are. It'll still involve, us collecting documents from you, but it's a far less painful process than essentially, back and forth with the lenders and, running separate processes, because we're able to do that simultaneously with multiple lenders. So that's essentially what we do, but why don't I talk about a couple of case studies just to give you a sense of the kind of companies that we have worked with and what kind of structuring that we've done. Kevin, if you could just go to the first case study, please. The next slide, actually. Great. So this is essentially, one of the solar companies that's a client of ours. They are one of the winners of the SECI tender last year, which means that they now have an order book of companies that they're going to put rooftop solar installations on. And they came to us because they needed money both for their own working capital as well as long-term funding to finance these projects that they're signing PPAs for. So what we do as Loans for SME is study all the contracts that they have, study all the receivables and cash flow cycles, and then in the last year, we have now closed 4 transactions with them, which include a short-term funding for their own working capital, an order-based funding, as well as a long-term funding for a PPA that they signed with a high-quality industrial client. I'm just going to talk about one more case study before we move on to any questions that we have. So Kevin, if you can just go to, we can probably skip the next case study in the interest of time and go to the third case study. Great. So this is a bioenergy company, a company that does waste to energy projects. But I would say that in the way they work, which is to get orders from a customer and then manufacture a product and sell it, will resonate with a lot of cook stove companies here as well. So this company again came to us with a bunch of orders that they had from AAA kind of customers, and they needed essentially working capital to buy raw materials and pay their suppliers to even build the project. And this was a 9-month cycle, which means that once you finance the suppliers, they will manufacture the product, sell it, and then get the money back between 6 to 9 months' time. So we, after our analysis, felt that an order-based funding would be best suited for this company. And we connected them to a family office who was very interested in the projects that they were doing and was able to use the escrow of the future cash flow of this project. So I'll just clarify what escrow means here. So basically escrow means that if they're giving you a loan today, when your customer pays you 9 months down the line, the money goes back to the lender so they can get their loan back directly from the customer cash flows. And based on that comfort, they were able to give this company a 75 lakh loan, which was more than enough to propel them to essentially fulfill that order. And it essentially became a cycle for them to take on more orders. And I believe they've grown their revenues by about 3x in the last 1 year. Great. So that's where I'm going to stop. And I know some of you are here and, can have questions, but If you also want to spend more time with us in terms of just talking about a specific situation and your financing requirements, I'm also going to be at the Clean Cooking Conference later this month. We are doing a session there on debt financing, so we'll be very happy to meet you there as well and talk about your specific financing requirements. Over to you, Kavina, and to any questions that we have.
Terrific. Thank you, Simi and Meenakshi, for that terrific presentation. I certainly learned a lot, and I hope our participants did as well. I'm looking through some of the questions here, and we'll pull up a few as I review briefly. So as a reminder, if you have any questions for Simi and Meenakshi, please type them into the chat window. All right, let's see. Okay, we've got something here. I see. Okay, we have one question that would like for one of you to describe a little more about interest rates for different forms of financing. I suppose what are typical ranges, and what do those rates and how they're formed depending on the financing mechanism?
All right, so it's actually quite a wide range of interest rates that you get, but the basic premise on which the interest rate rests is the risk that we perceive in that particular structure and the company. But just as a very general benchmark, we have seen that collateral-backed or asset-backed lending in India for small businesses happens in the 12 to 14% range. Unsecured lenders who do invoice discounting or order-based funding, because they do not have any real estate as security, tend to be a bit more expensive. We have seen most of our clients getting loans in the 16 to 20% range. So I would say 18% would be about the average for unsecured lending that is offered on our platform.
Terrific. All right, the next question asks, hypothetically, if you are a new company that has already experienced a loss but has bankable energy efficiency project that's worth 50 million Indian rupees, would it be possible to finance this kind of a venture through debt?
So I guess the question is, one, can a loss-making company get funded? The answer is yes, subject to a lot of conditions, obviously, but yes, a lot of our clients are not profitable. They are still at a stage where they are not making any profit. What we like to see, though, is a clear path to how they will become profitable, or how the lenders will get repaid. So in this case, if they have a bankable project, and we can show both that the company has the skills to execute that project, and to the customer who will be the off-taker for this project is creditworthy, it's definitely something that is possible.
Great. Okay, another question here. Let's see. Okay, so for the companies that you usually work with through your platform, what are the typical revenue sizes that they generally need to access some of the lenders?
So I would say that I would not think of it as specific revenue size, because we work with companies with revenues as low as like 1 crore rupees, all the way to companies with revenues in hundreds of crores of rupees. But as a benchmark, I would say that for companies which are young, say 1 to 2 years old, are still finding their feet in having a stable revenue cycle, we typically see transactions happening at ticket sizes of between 1 to 2 months of revenue run rates. So if your revenue is, say, 60 million a year, you could probably get, a 10 million kind of a loan at max. It will eventually come down to your working capital cycles and how much cash you can generate to repay the loan and how much certainty there is around that.
Okay, excellent. So I think I understand this question, but hopefully we will, as a collective group, answer it well enough for our participant. But I suppose they're asking if you have a loan takeover option. Maybe I have to rephrase this. I'm trying to think. Do you have a loan takeover option? I suppose they're asking if you're in a situation where you have a loan can you have a loan takeover option if there is already an investor or lender?
Yes, so I think loan takeover is when you have a new lender take over the loan. Yes, that is an option, and you would typically exercise that when your existing loans are very expensive or not enough, and you want a new lender to come in, and that is something that we do look at. What we do not work with as a platform is stressed companies, and by stressed I mean not loss-making, but essentially companies who have been, gone through a business cycle and are not expected to be growing very rapidly. Those are the kind of companies that we do not work with. But if you have, a business model with high growth potential and you need a new lender to come in to take over an existing loan, we do work on those deals as well.
Terrific. So we have a participant here from East Africa, and actually, is Loan4SME, do you have a platform available in the region?
I don't, but if you were to, Kevin, if you know who that is, and if you could connect me, I'm happy to connect them to a platform that is operating in East Africa.
Yeah, I think that's a great point, and because we do have some questions here that are very specific to their business, and I think would absolutely benefit from an offline discussion. So Meenakshi or Simi, maybe the best way to share your contact information may be in a follow-up note or email to the participants?
Sure, we'll be happy to do that and very happy to answer any offline questions. We also, are part of essentially, I would not call it an alliance because it's nothing formal, but we do have collaboration with lenders based out in Africa, in Europe, and in Far East Asia. So if there are any cross-border requirements or any, international requirements, we are happy to make the connects.
Terrific. Yeah, I think that helps out with one specific question, and in fact, keeping to the theme of East Africa, we do have one question that is kind of interesting and may be of interest to also discuss offline is, can, I guess, activities or programs like behavior change and awareness that can stimulate demand in a market for cookstoves and fuels, for example, can that be financed in any way?
So typically, any market-making initiatives, that are not backed by any specific cash flows are, funded out of equity money is, our sense of how the market works. But I think the honest answer is it depends. So if you're a large enough company that already has existing capital, in your company and are looking to grow, venture debt is a great option for growth capital. But for a new company to bring in debt for any market making or marketing activities would be difficult.
Excellent. Okay, great. Yeah, so question here, does Loan4SME support or provide any services that relate to export-import line of credits especially with regards to exports from India to, let's say, other countries in Africa, for example?
Yes, we do. Both through domestic financing, which is available through our lending partners, as well as through international factoring partners who are able to provide cross-border invoice discounting.
Terrific. Question here on Loan4SME's revenue model. Do you take kind of a fee-for-service model, or do you have lending institutions provide payment to you for your services? What are your typical ways of payment for your services?
It's actually a very simple model. We believe that we add the most value to the companies who are providing access to capital. So we do charge a fee when you get a loan sanction through us. It's not a huge. It's actually a fee of 1% that's payable on loan sanction.
Terrific. And from your experience, this probably depends on the type of financing mechanism, but how long typically does a process take from initial application to approval of a loan?
So once we have all the documents, and I think that's a big caveat because companies do take some time to collect the documents that lenders need, although they're typically things like financials and tax returns and bank statements. But once we have all the documents, the process can take anywhere from 3 weeks for an invoice discounting to about 6 weeks for an impact lender doing long-term venture debt kind of structure. But I would say 3 weeks is probably, 3 to 4 weeks is probably where most of our deals would happen.
Excellent. Good. Okay. Let's see. Yes, and just another friendly reminder, we still have a few minutes left on the webinar, so if you have any remaining questions, please feel free to type them into the window. We have one other question here.
Yes.
Let's see. So, as part of your services, do you also advise enterprises on what type of funding option or mechanism to pursue? Yeah.
Yeah, I think that's the key part of what we do. So as I said earlier, enterprises often do not know, what lending means and what the right options are. So we play an advisory role in finding the right structure and the lenders for them. So we spend a lot of time with enterprises just looking through their numbers, their plans, and then advising them on what makes the most sense given their capital structure.
Absolutely. Okay. Maybe hang tight for a few more seconds to allow any last-minute questions to roll in. Okay. Well, I think that is a wrap. For the participants, if you have any other questions for the presenters, and if you'd like to get in touch with them, it looks like there are some very interesting enterprises and partners who'd like to learn a lot more about Loan4SME and potentially collaborate together, which is terrific. So on behalf of the Global Alliance for Clean Cook Stoves, I want to thank all the participants for your time and for your attention and for taking time out of your day to participate in a joint webinar with the Alliance and Loan4SME. We hope you enjoyed this presentation and will be able to apply some of those learnings to your own enterprise and business. And to the presenters, Meenakshi and Simi, thank you for a really terrific presentation. I think we all learned a lot, and I hope this is something that you will have an opportunity to continue speaking about at our upcoming forum. And if any of you are attending, we look forward to seeing you there. In the meantime, please note we did record this webinar. We will be sharing the recording soon, and we encourage you to share the recording with your own colleagues and within your own networks and spread the word. Thank you again. Take care and have a great evening or day wherever you are in the world. Bye-bye.
Hi, Kevin. Thanks so much.
Thanks so much.